Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now to this episode's lecture. Statement of cash flow, IAS 7. Now companies are required to include a statement of cash flows in their financial statements. So in this lecture, we shall take a look at the required format and explain how to prepare a statement of cash flow. A statement of cash flow is simply a summary of the cash receipt and payment for an institution for a period. The purpose is to provide users of the financial statement with more information than is provided just by the statement of profit or loss and the statement of financial position. Accounting, as earlier said, is prepared under the accrual basis. So transactions are recorded in the statement of profit or loss based on happening, not when there's an exchange of funds. So for example, a company statement of profit or loss record a higher profit due to an increased revenue, which might cause one to expect that amount to sit in the company's accounts. That figure may not be reflective of the cash available because parts or all of the revenues might have been made on credit, which tells that the money is with the receivables. Statement of cash flows tells users of financial information the actual cash that came into the business and those that flown out within a particular period. Now, you may not be able to get that from scrutinizing the statement of profit or loss and the statement of financial position because they are prepared under accrual basis, which states that transactions are supposed to be recorded in the financial statement at the period when it occurs. So when you buy an item, even when you don't pay for it, you still have to record it in the financial statement. Now, there are two approaches allowed in the preparation of statements of cash flows. We have the direct method and the indirect method. So we'll start with the indirect one. Let's move on to look at the extract to the statement of cash flows. Now they are in 4 components. We'll start with the cash flows from operating activities. Now here we are supposed to focus mainly on the statement of profit or loss and the current assets and current liabilities of the statement of financial position. So we'll begin from the net profit before taxation, then adjust upwards for any non-cash items. So when we start with the net profit before taxation, we'll come and add any item that was subtracted in arriving at the net profit before taxation. We'll come and subtract any item that was added in arriving at net profit before taxation. So we'll add depreciation because it was definitely deducted. We will less profit on sale of non-current asset. Had it been a loss, it would have been added back. Interest expense, it was deducted, so we add back. Then we arrive at operating profit before working capital changes. Then we come to adjust for working capital. So increase in receivables is deducted. If it were to be a decrease, it would have been added back. Reason being that you have had an increase in your resources tied to third parties. So you are losing money. If it's inventory and you have an increase in inventory, also your resources are tied with third parties, which they are using to generate money and you are losing out. If it's a decrease in inventories, it will be an addition. Increase in accounts payable. You have an increase in third-party resources with you, which you are using to generate money. So it is cash inflow for you. If it's a decrease in accounts payable, you less it. Now the increase and decrease comes about when you compare the prior year for these working capital items to the current year. This will lead to cash generated from operations. Then you record the interest actually paid. So to estimate the interest paid, you have to go to the current liability section of the statement of financial position. If the interest is unpaid, it is supposed to feature there as interest payable. If there's no recording there, that means that the interest recorded in the profit or loss has been paid. So you bring it here and less it. The same for tax. But tax, you might have to go to the non-current liabilities if there's a deferred tax. Other than that, you just go to the current liabilities and you pick the current tax. Then you look at the movement. The next section of the statement of cash flow is investing activities. So here, it deals with investment into non-current assets and third parties. So if you sell non-current asset proceeds, it has to be an addition. If you purchase non-current assets, money has gone out, so you have to less it. If you invest in third parties and you receive an interest, it is supposed to be here. If you invest in equity in third parties and they pay you dividends, it is supposed to be here. Then you have net cash used in investing activities. The third section is cash flow from financing activities. This has to do with activities leading to inflow and outflow in securing funds to run the business. So when you issue shares, people subscribe to it and money comes in. So you put it here as a positive. When you go for a long-term loan and you pay it up, money has gone out, so you less it. When you go for the long-term loan, the principal that they give to you is an inflow, so you add it. Dividend paid, when people invest in your business and you're supposed to give them return, that's the dividend. It is supposed to be here. Don't confuse it with the dividend received, which is an investing activity. It will lead to a net cash generated from financing activity. The last section is cash and cash equivalent. Now, the net increase or decrease in cash and cash equivalent has to do with the summation of the final values from the three sections above: operating, investing, and the financing. You either get an increase if it's a positive figure or a decrease if it's a negative figure. Cash and cash equivalent has to do with the cash amount or the bank amount in the financial position. You have to do with short-term investment, then you adjust it or less it with bank overdrafts. When you net them off, becomes the opening inventory, which is the prior year. The closing inventory also have to come below. So when you add the opening inventory to the net increase or decrease in cash and cash equivalent, that is supposed to give you the closing figure for the cash and cash equivalent. If it does not, then it means that there's an error somewhere which needs to be rectified. Then cash and cash equivalent also can be estimated on its own. You pick cash, you do the movement. Cash equivalent, short-term investment, you do the movement as well. Then overdraft, you also do the movement from the current liabilities. It is supposed to give you the net figure as you will get above. Now, the workings that we spoke about here. So for working capital inventory, you compare prior year to the current year. You estimate the movement. So for receivables and payables. For interest paid, you move to the current liabilities. Interest payable amount there. You bring the opening balance, which is the prior year figure, credit it. Then the interest stated in the profit or loss, you also credit it. When you move to the debit side, you put the closing balance, which is the current year figure. Then you close it. The difference that will appear will be the interest actually paid. When we move to dividend paid, we work out the retained earnings. It's an equity, so it's credit balance. So the opening balance, which is the prior year figure, will be credited. Then the profits derived from the statement of profit or loss, we credit it. Then we move to the debit side. We record the closing balance, which is the figure for the current year. Then we close it. The difference that will arise will be the dividend actually paid. We move to the tax paid. You check from the non-current liabilities section if there's a deferred tax figure. If there is, you credit it with the prior year figure as an opening balance. Come to the current liabilities, credit the prior year figure also there. Then you credit the tax stated in the profit or loss here. Debit the current figure for deferred tax. Do same for the current figure for current tax. You close the account. The difference that will arise is the tax that was actually paid. When we come to non-current assets, we debit it with the prior year figure, which is the opening. So here what we are trying to estimate is that there is an opening figure and there's a closing figure. When there is a movement, we need to know what are the elements that will account for the increment, aside from buying more of the item. So revaluation can account for the increase. Depreciation can account for the reduction. Disposal can also account for the reduction. So if there is a revaluation, you debit it. If there's a depreciation, you credit it. If there is a disposal, you credit the current amount of the assets, not the proceeds. Then we close them off. The difference that arises will be the actual investment in non-current assets. When we come to equity shares, you just look at the prior year figure for share capital and share premium. Then you estimate the movement. For borrowings, if the prior year is less than this year, it means that there's an issuance of debt. If the prior year is more than the current year, there has been a repayment of the debt. Let's test our understanding. The following information relates to GKA, a limited liability company for the year ended 31st December 2020. Now we have the extracts from the statement of profit or loss for the year ended 31st December 2020. We have the finance cost, investment income, profit before tax, then less tax, then profit for the year. The statement of financial position is also stated here. We have the assets column. We have the equity and liability columns. So additional information. So depreciation expense for the year is stated here. The asset with the current value of 1,974,000 was disposed of at a profit of 720. So we have to prepare a statement of cash flow for the year ended 31st December 2020 for GKA Limited. We start with the cash flow from operating activities. As said earlier, we will start with profit before tax, which is 15,000 in the question. Finance costs and expense, it was subtracted, so we add it. Investment income, we are not sure whether the cash has actually been received. Incomes are added, so we less it. Depreciation, as stated in additional information, we add it back. Profit on disposal, 720. Profit are added, so we less it. We come to the working capital section. So if you look at the workings to the left, you see that the inventory figure for 2019 is more than the 2020. There has been a decrease, so you add it. For receivables, there was an increase, so you less it. Payables, there is an increase. So you arrive at a cash generated from operations figure of 26,568. When we move to interest paid, if you check the statement of financial position, there is no payable element at the current liability section. So what it means is that the interest that was stated, that was adjusted for upwards, is what was actually paid. So you come down here and you less it. Then when you come to the tax paid, open the T account, credit it with the closing for 2019. That's 2,760. Then the tax in the profit or loss account, which is 4,350. Then we debit it with the closing balance for 2020, which is 3,020. When we close it and we strike the difference, it's going to give 4,090. This is the actual amount of tax paid within the year 2020. That is what we less from operating activities. So for cash flow from operating activities, there is 22,078, meaning the operational activities of the GKA led to an actual cash inflow of 22,078. But if you check, the statement of profit or loss was giving you a profit of 10,650. When we come to investing activities, we first look at purchase of non-current assets. The opening was 26,574. That is the figure for 2019. Then we come to the credit side. Depreciation was 4,658. An asset was disposed for 1,974. Then the closing balance, that is the figure for 2020. So when we close it will be an increment of 23,340, which is an outflow. When you buy assets, money goes out. Proceeds from sale of non-current assets. Now, a non-current asset with a current value of 1,974 was sold and a profit of 720 was made. So we added 2. That is the actual amount of money that was received. When we come to dividend received, there was a finance income, the statement of profit or loss. This has no corresponding entry in the current asset column as a receivable, and there's nothing stated in additional information. So it means that it was actually received. It will lead to a net cash generated from investing activities of a deficit of 20,466,000. There are 3 zeros upwards, so kindly take note. For financing activities, we'll first deal with the issue of shares. Comparing the share capital of 2019 and 2020, we realize there is an increment of 1,869. So we put it here positively. There is an issue of loan. There has been a reduction. 2019 was 10,300. 2020 is 8,000. It means that an amount of 2,300 has been paid out of the loan that was secured. So we less it from here. Dividend paid. So we come to retain earnings. If you credit it with the opening balance for 2019, 6,465. Then the profit from the statement of profit or loss, 10,650. You also credit it. Then you debit it with the closing figure. That is the value for 2020, 16,115. Then you close the account. It will lead to a difference, which will be the dividend actually paid of 1,000. And net cash generated from financing activities of a deficit of 1,431. So we move to the cash and cash equivalent. We sum the 3 results from the sections. There will be an increase of 181. So when we bring the cash and cash equivalent at the beginning of the period, there is a cash opening for 2019. That's 1,063. And there's also a bank overdraft of 429. When we net the two, we'll arrive at 634. Now the cash and cash equivalent for the closing, there is a cash for 2020 of 2,045 and a bank overdraft 1,230, which will lead to a closing of 815. When you even add the 181 and the 634, you're supposed to get 815. We move straight into discussing the direct method. Now the direct method is the least approach being used. You hardly find people using the direct method, but we'll still go through it. Cash flow from operations is estimated by directly taking the cash receipts from customers and deducting the cash payments. So the only difference between the direct and indirect is the cash flow from operating activities. So looking at the extract, you have cash received from customers, payments you made to suppliers, you less it. Cash paid to on behalf of employees, you less it. Other cash payments, you less it, which will lead to the net cash flow from operating activities. Now, when you use this method, you're supposed to get the same value going the indirect route. Let's look at the test of our understanding. So Gatis has the following statement of profit or loss for the year ended 31st December 2019. So you have the revenue, cost of sales, gross profit, distribution and administrative expenses, then the net profit before tax. Then the following extract was taken from its financial position. So you have the current assets, the inventory, trade receivables, current liabilities, the trade payables. Okay. So because you're focusing on just the operating activities, that's how Kambi didn't present the full presentation of the statement of financial position. So additional information. We are told that expenses include depreciation of $36,000, a recoverable debt written off of $14,000, and employment cost of $42,000. Also during the year, Gatis disposed of a non-current asset for $24,000, which had a book value or current value of $18,000. the profit on which had been netted off expenses. So we are required to show how the cash generated from operations will be presented on the statement of cash flows under the direct method. I would urge you to solve this on your own using the indirect method. So we are going to tackle it from the direct method angle. Let's look at what we actually receive from customers. So you have a trade receivables opening. You have people who are owing you to the tune of $235,000 from 2018. Then you made extra sales of $1.2 million. From additional information, we were told that $14,000 was written off. Then at the end of the year, you still have people of $259,000 owing you, which is give us $1,162,000. When we come to cash pay to suppliers, you have to look at cost of sales, inventory, trade payables. That will inform you the money that is supposed to go out or pay to your suppliers. You have an opening owing of $138,000 to your payables. Then you have your cost of sales of $840,000. Okay. Now, cost of sales is made up of opening inventory, you add purchases, then you less closing inventory. So what we are trying to estimate is the purchases that was made for this current year. So opening inventory was added in arriving at cost of sales. So we less it, which is the $140,000. And closing inventory was subtracted. So you add it back. So when we get the purchases, out of the purchases, $168,000 is still outstanding. So it will give us cash paid of $830,000. Now, cash paid to employees, as stated in the question, is $42,000. Now, when we come to other cash payments, we will pick the distribution and administrative expenses, which is in the statement of profit or loss. We'll adjust for all non-cash items. So we pick the $120,000, which is the distribution and administrative expenses. Then we less the $36,000, which is depreciation. We less the $42,000, which is already captured above for employees. We add for profit on sale of the non-current assets. The proceeds was $24,000 and it had a net book value of $18,000. So there will be a profit of $6,000. Now this $6,000, they said this amount has already been netted off. When an income is netted off an expenditure, it reduces it. So we add it back. Then we also reduce it by the $14,000, which is the debt written off. It will lead to other cash payment of $34,000. When we sum them, we're supposed to arrive at a figure of $256,000. My people, this is where we bring our discussion to an end. I hope you understood everything that we spoke about. If not, feel free to drop your comment and your feedback in the comment section below. Also, feel free to reach out on any of our social media handles as listed here. And don't forget to subscribe. Till we come away again, by way of tutorials on the go, take care of yourself and stay blessed. Poker.